All right, everyone, it's time we talk about Alibaba and Chinese stocks. The amount of, yes, I'm going to use the term again. I know I say I don't like it, but this is one of those situations where I literally think that there is FUD, fear, uncertainty, and doubt, and it is rampant right now with Americans viewing Chinese companies and Chinese stocks. So what I hope to do in this video is go through my entire thought process on Alibaba and navigate through the muck of what's going on over there. Should we be concerned? Is this a buying opportunity? Is this a case where we sell out because it's too dangerous, right? I want to go over everything, give a total overview of the situation, the potential opportunity, as well as the risks that exist. I want to show both sides of the argument. So we're going to watch video clips of people like Kyle Bass that are very much against U.S. investors investing in China. He warns sternly about the risks and shows his point of view. And then we'll also see the other side, where I think there's people that are saying that there's a lot of things that are simply just people being unnecessarily fearful for actions that China's taking that they really don't need to be. So we're going to go over everything with Alibaba in this video. I first want to start off by just giving a glance at my portfolio. It's at $97,000 in value, so it's gone down a little bit over the past, well, it's up over the past month, right? So longer term view, it's up. If I look in the past week, it's down 0.22%, and then today it's down pretty big. So 2.59%. So I was up more. Now it's coming down a little bit as we see some of these things happen with different companies like Alibaba. Alibaba is a new holding. I sold out of Teladoc and moved my money into Alibaba. And this is one of those cases where right now I'm in the red. I'm trying to decide what to do, but I think I've made up my mind already on this stock in this company, and I actually believe that it still presents one of the best values, and it's one of the best companies easily in the world. I really believe that, and I want to go over that in this video. So let's go ahead and jump right in. Let's start off with this is an article from the Wall Street Journal. I'll go to it right here. Jack Ma's Ant. This is Ant Financial, which is an affiliate, like a subsidiary of Alibaba, talks to share data trove with state firms. Ooh, the CCP, the Chinese government, right? Jack is now having to share private data of the users with these state firms. Now, the article goes through, it's very detailed. So I'd actually recommend reading this if you want to go into detail. I'm not going to go into all of it in this video, but I'll go ahead and I'll look at the Seeking Alpha summary just to hit the highlights of it. So this is Seeking Alpha going over that article in the Wall Street Journal, and they highlight some of the key points here. And this is, after reading the article, this is the same thing that I would highlight. So it says, Baba's down 7% Monday as the Chinese e-commerce kingpin felt the impact of new pressures that Beijing is putting upon some of the country's biggest tech companies. So this isn't exclusive to Alibaba. This is a lot of different companies in China. They say Alibaba affiliate, which is the Ant Group, is in talks about sharing its customer data with the Chinese government as part of a new credit scoring business. The journal said that under the arrangement, Ant Group's Alipay would give up some control of its data to individuals, and such information would then be easily available to multiple Chinese state-run enterprises. According to the journal, the new company could be up and running within a matter of months. Alibaba's shares went into the red early Monday and finished at 191.76. So this is down a lot. Alibaba is falling quickly. To give you a bigger view of what's going on, let's go ahead and look at Alibaba's stock. Just today, it's down 5.25% right now. By the time you even see this video, it could be down another 5% for all I know. If we look year to date, it hit a high of around 270 and it's down 32%. If we look back even further, we go back a little bit further, it was up to 317. So this stock is down 42% from all-time highs, right? Right around 42%. We look at JD. This is another one that's been hit. This is another one that's fallen a lot since its all-time highs. It's down 41%. There you go. Now you can see it. Then we look at Tencent. This is another one. If we look at the trailing 1 year here, it's down 43%. Then we look at Baidu. This one is down 54%. So these stocks are falling like crazy. And a lot of it has to do with the continued news like this. News article after news article of different things that the Chinese government is doing. Let's go ahead and actually continue on reading in to what China's doing, at least with Ant Financial. What they're doing is they're saying this credit scoring business, we're basically making this information public of people's credit. And then the Chinese government will be able to make that information public so different lenders will have access to people's credit. This is something that already happens in the US government. So China's literally making their system mirror the US system more closely. They're not moving away from it. They're making it so that credit information is available to public or at least governmental credit rating agencies, which is exactly how it works in the United States. So while people are panicking over this news, this is China saying, hey, we want to be responsible. We don't want all this credit rating data to be private to a company like Ant Financial that is a private owned company, right? That's what they're doing with this news. They say Alibaba's shares went down on Monday. It finished at 191. It's down even further from that. The deal has implications for the privacy of more than 1 billion Chinese citizens who use Ant Alipay for financial services, such as borrowing money, paying bills, and making everyday purchases. The Alibaba situation is one of the latest to highlight the role the Chinese government plays in many of the country's business operations. Earlier this year, China's State Administration for Market Regulation levied a 2.75 billion fine on Alibaba for anti-monopoly violations. Again, anti-monopoly violations is something that the European government and the US government routinely levy on our companies. Look at how many times Europe has fined Google or Apple for anti-competitive reasons. It has to be at least half a dozen times. So I read news like this, a $2.75 billion fine. That's kind of pricey, but not really for Alibaba. This company, that's like a little speeding ticket. So it's a decent chunk of change. 2.75 billion is a lot of money, but Alibaba is a massive cash cow. So this is saying that you have to play fair. A lot of people can look at this news and they get completely different takeaways. Even on my Discord, there's people's replies to looking at this article, and some of them say, hey, this is why I'll never invest in China. And other people say, this is them just regulating their market, right? They're essentially doing the same thing that Europe and the US are doing. Let's go ahead and continue on with this. Let's look at some of the arguments here. This is Kyle Bass. He is what I would call, I would describe Kyle as, in terms of China, he is like the chief FUD spreader, the fear, uncertainty, and doubt spreader. Every time China does something with regulations or fines, or the Chinese government does anything, CNBC brings him on and he explains how China's bad. Every investor should stay away. You really own nothing when you own a Chinese stock. And that's basically the message over and over again. And it has been that way for years with Kyle Bass. He is a very, I guess, I have an American flag. I love our country. I like America. But I also like to look at different investments across the world and as objective as a way as possible. Kyle Bass does not like any investment that has to do with China, and I think a lot of it is largely political. So let's go ahead and listen to some of the arguments that he has for what's going on right now.
One of your prior guests said that even Stevie Wonder could see what was going on, and I'm going to tell you, it's easy to see once you understand the fundamental ideology of the Communist Party of China. All of the things that are happening today are impossible to discount. They're easy to see coming at some point in time. And I think that's where, when we think about investing, first of all, Chinese companies won't submit themselves to covered audits like all U.S. companies do. Now you have to discount Xi Jinping risk or Communist Party risk. How can you pay a huge multiple of earnings with all of those things in front of you? This is going to be a panacea for plaintiffs' lawyers and for individual investors when they start bringing arbitrations against their fund managers, their brokers, their RIAs. I mean, there is no defense for a fiduciary that invests in China today.
Right off the bat, he's basically saying, if you're a fund manager and you're a fiduciary or you're anybody that's managing someone else's money, they're going to sue you for investing in China because it's so irresponsible. He's trying to scare fund managers out of having their money in China. Let's continue on.
it's impossible to discount. They went after the food companies yesterday. They went after for-profit education the day before. It all started with Ant Financial, and now it's moving into Tencent and tech. And what's next? Healthcare. I talked to a bunch of my friends today that are big global asset managers, and they are finally starting to really materially pull out of China and Hong Kong. This is just the beginning.
So we have a very stern warning from Kyle Bass saying, if you're a fund manager and a fiduciary, if you have responsibility over other people's money, you better be careful because you're going to be sued for how irresponsible it is to put money into China. And on top of that, the Chinese government, the overall plan is to control everything, right? It's the big bad Chinese government. Everybody knows that. This is what Kyle Bass has said for a very long time. So this isn't like a new take from him. This is what he's been saying for years. He's just repeating it now. He's brought back onto CNBC because this is what's in the news right now. Let's go ahead and get someone else's opinion on this subject, though. I don't want to only get Kyle Bass's. Let's go ahead and look at Charlie Munger's here. I'll move the camera here so we can see him a little bit better. This is Charlie Munger asked, I think a few months back, on his thoughts on China and whether the government is going to prevent their companies from being successful.
Well, I think that the Chinese government will allow businesses to flourish. It was one of the most remarkable things that ever happened in the history of the world when a bunch of committed communists just looked at the prosperity of places like Singapore and said, the hell with this, we're not going to stay here in poverty, we're going to copy what works. And they changed communism. They just accepted Adam Smith and added it to their communism. And said, now we have communism with Chinese characteristics, which is China with a free market with a bunch of billionaires and so forth. And they made that shift. They deserve a lot of credit. Warren and I are not quite as good at that as changing our minds in many cases.
Yeah. So he's laughing there, but Charlie Munger is not concerned about the Chinese government. And he's even gone so far as to point out that in some cases, the regulations that they're doing right now with their companies is something the US should be doing. So for instance, with the financial system, the stuff they're doing with Alibaba, the preventing the IPO and the Ant Financial taking over all the financial system, Charlie Munger was there saying that's probably what the US should be doing. The US is letting a lot of fintech companies that have no banking regulation take over everything, and he's surprised that that hasn't caused any trouble right now. So he's in the group where he actually thinks that more regulation, not less, is necessary, and he does not believe that China is going to destroy their best companies. So much so that Charlie Munger has $37 million invested into Alibaba, and he bought, I think, at like 220, somewhere around there. So he's invested in it. Right now, it's below his buy-in price. So you're getting various different perspectives here. You have Kyle Bass, who is very much against investing in anything China. You have people like Charlie Munger, who thinks, they're not going to destroy these companies. They want to flourish and grow as well, but it's smart that they're doing these regulations. In terms of nationalization and nationalizing different industries, that's not something unique to China as well. Them saying that we want to make this credit data public is something that the US is already doing. Them saying that they want to nationalize some different industries like education is something that would not cause headlines if any country in Europe did it. If Europe said we want to make, and I say Europe broadly, but pick any country in Europe, Sweden, France, UK, whatever it is, any country, and if they said that they want to nationalize more stuff with education, it would not be making these type of terrible doomsday headlines. The US, Europe nationalizes many different industries from power, transportation, a lot of education, a lot of financial parts of the economy, and that doesn't cause as many headlines. So a lot of this is kind of the halo effect of China. When the Chinese government does anything, it gets headlines. Even if it would not have gotten headlines if the US government or if Europe, any parts of it, did the same thing. For instance, I can show you an example of this. This is something that gets a lot of attention right now. We have post after post on Reddit right now talking about Alibaba, and there's lots of subjects like this. Where's the value in owning Chinese stocks? I go down to the second most upvoted comments. This has 90 upvotes, and here's a very a very common take. I've seen this over and over again in regards to China. When you invest in a Chinese company like Alibaba in the US, you actually invest in a holding company which has a contract with the Chinese company granting them the rights to a share of their profits. You're right that you don't own the Chinese company directly, but you do own something that has a legal right to the profits of the Chinese company. So the takeaway that a lot of people are getting from this is when you invest in an ADR company, a company like Alibaba from the US, you don't actually own anything. That's been the often repeated message. This is called an ADR stock. That's what Alibaba is, and many Chinese stocks. It is a more convenient way for people in the US and in the West to get access to companies like Alibaba. The description of it says, an American depository receipt is a negotiable certificate issued by the US depository bank representing a specific number of shares, often one share of a foreign company stock. The ADR trades on the US stock markets as any domestic shares would. So this is some financial engineering in a way that they have an intermediary between Alibaba and the US. They have a bank that sits in between that does some legal work, so you have access to Alibaba. And this has often been, again, another tool to spread FUD, fear, uncertainty, and doubt. People are saying you don't really own anything when you own a Chinese stock. Let me go ahead and go through the list of other countries that have stocks listed under ADR. The exact same setup, right? And have you had this pointed out anytime you invest in these companies? Royal Dutch Shell from the United Kingdom. That is an ADR stock setup with the exact same mechanics. It works the same. It's the same type of financial engineering, but yet for decades, people have invested in Royal Dutch Shell from Europe, and you probably haven't heard this concern one single time. That is the difference right now. Everything with China is brought up as a concern, and even though it would be identical to Europe or the US, you never hear about it in the Europe or US. The only reason that it's brought up as a concern is because it's China, and it has that bad halo effect, right? Whenever China does anything, you hear about it with the government. This is the amount of companies right now listed as ADR stocks. We have the United Kingdom. Look how many there are. This is all just the United Kingdom. We have Turkey, we have the Netherlands, we have Taiwan, Switzerland, Sweden, South Korea, South Africa, Russia, the Philippines, Peru, Norway, Mexico. We have Japan, Italy, Israel, Ireland, Indonesia, India, Hong Kong, Germany, France, Denmark, and then China. But it's bad when China does it. It's fine when all these other countries do it. When these countries do it, you're not going to see it posted on Reddit. You'll never see it brought up on the comment section in Reddit or online anywhere. But when China does it, it's bad, right? That's the difference. China has a lot more companies that are ADR stocks because they have a lot more companies. They're a much bigger economy than most countries in Europe. But even continuing on past China, we have Chile, we have the Cayman Islands, Brazil, Belgium, Australia, Argentina, so on and so forth. 452 companies in total just on this website. Trillions of dollars worth of stocks listed ADR style. So again, you hear about this because it's China. All of a sudden it's a concern because it's China. But when Europe does it, when lots of countries in South America and Africa do it, it's not a concern. Now, another thing I want to transition to here is Alibaba, the company. So let's go ahead and ignore all the stuff surrounding it with the government and what they're doing and what they're not doing, but actually look at Alibaba, the company again, okay? I already did an overview of this in a previous video. You can look at it, but I want to look at Alibaba and compare it to Tesla. Tesla had a phenomenal earnings report. There was literally nothing bad about it. They're profitable. They're growing quickly. It's a great company in the United States. It has a huge TAM and market opportunity with autonomous vehicles, robo-taxis, so on and so forth. So Tesla's a company that is in very good shape. It's doing really well in the United States. It has a bigger market cap right now than Alibaba by over $100 billion. So Tesla's a bigger company than Alibaba in terms of market cap. Let's go ahead and compare their revenues. This is their top line revenue growth quarter over quarter. And we have Alibaba in red. We have Tesla in blue. As you can see, Alibaba has over double the amounts of revenue. But more importantly, Alibaba is growing their revenue at the same speed as Tesla. So even though they have double the revenue, they're growing it at the same rate. That's pretty incredible. Now, revenue is not the only important thing. What about operating margins, total addressable market, profitability. We can look at some of those things as well. We have Alibaba here with their net income. Last year, they brought in $22.13 billion in net income. In the trailing 12 months, they brought in $24 billion in net income. Alibaba has high operating margins. They're a very profitable business. Tesla, for comparison, in the trailing 12 months, brought in $2 billion in net income. So Tesla's at $2 billion. Alibaba is at $22 billion. Alibaba has double the revenue, and it's growing it at roughly the same pace as Tesla. In terms of market opportunity or total addressable market, both of them are massive. Tesla has a massive market opportunity if they do take over robo-taxis and autonomous driving, but Alibaba does too. The online retail market that they compete in is massive. In fact, every industry that they compete in, the market is well over $1 trillion. So you have core commerce, cloud computing, massive market, digital media and entertainment, massive market. So this is a company that, similar to Tesla, has a total addressable market that is, numbers can't really go that far, right? It's multi-trillion dollars in these different industries. But more importantly, they're actually growing. They have profits. They have high operating margins. Then if we look at moat rating by Morningstar, they give Alibaba a wide moat. That's difficult to get. A lot of companies that are even good companies don't have that. Even Apple doesn't have a wide moat rating. Tesla doesn't have a wide moat rating, but Alibaba does have a wide moat rating. They also say that Alibaba is undervalued, but valuations aside, just looking at the numbers themselves, we know that Alibaba is a great company, independent of the Chinese government. So that's what I want to highlight. It's a great company. You might think that the market is always smart in the way that it reacts and that it prices great companies, right? If Alibaba is going down in share price, you might say that's deserved. The Chinese government, there's way too many risks with that. I would never invest in Alibaba. But you have to understand that this happens all the time with even great companies. They frequently trade far away from their actual value. The price fluctuates, in some cases, dramatically away from their actual value. We can look at this article. Do you even remember this? The Cambridge Analytica scandal from Facebook? Is that even a part of your memory right now? I know a lot of you you're leaning back going, oh yeah, I remember that. That's when people were worried about Facebook and people hacking data, or like a plugin that stole a bunch of people's data and sold it. Is that ever brought up anymore? This entire scandal that consumed the headlines for weeks on end, that Mark Zuckerberg had to go before Congress, had to talk to him. It was a whole fiasco. It was the biggest worry. Facebook was the bad guy. There's going to be big regulations. This caused Facebook, their stock, to go down 40%. And that was over the course of months. It was an ongoing, horrible experience for Facebook investors. We can look at the stock price here. Let's go ahead and bring up this chart. This is back when this is happening. I'll zoom in. We have 2018 right there. And then we have the peak. We have it going down, right, 40% from highs to lows. That was the Cambridge Analytica scandal. Now, the investors that saw past this, which I know some that did, they wrote about it in their hedge funds or whatever, and they said, we're buyers during this. We think that this will be short-lived. They now have returns of roughly 200%, right? Just shy of 200% since that time period. So that was something that happened that most people don't talk about anymore because the news moves on very quickly. Will this happen with Alibaba and the Chinese crackdown? What's going to be the next thing next month that people talk about? We don't know. But in my opinion, I don't think that this is going to last forever. There's lots of times where the news likes to make it feel like there's something that's the biggest deal in the world when it's really not. Now let's go ahead and move on to this. This is the last clip that I'll show. This is Jeff Bezos talking about the dot-com bubble, because Amazon existed before the dot-com bubble and the stock price got completely crushed, even though there wasn't really anything happening with Amazon, the company. So this is how Jeff Bezos saw this. This is what he thought during that time.
So most of those internet companies of the dot-com era are out of business.
Yeah.
You survived. What was it that made you to survive, and virtually the rest of them are gone?
Well, that whole period is very interesting because the stock is not the company, and the company is not the stock. And
right there, Jeff Bezos is a better investor than most investors. That phrase right there, the way that he views it, the stock is not the company is not the stock, right? You have a company, the fundamentals of it, what it's actually doing, the profitability, its future prospects, And then you have the stock, which is the share price going up and down. He's saying they're not the same thing.
So as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way. And we didn't need to go back to the capital markets. We didn't need more money. The only reason, a financial
He's highlighting the problem here that a lot of the tech stocks faced is when the dot-com bubble happened, the reason that many companies failed is they were reliant on the capital markets or the debt markets. They needed to take out debt to fund their business. But he's saying that they were profitable, so they did not have to go back to the capital markets. So they were fine. The business was flourishing. They didn't need to take out any more debt. They could just keep doing what they were doing. So they weren't in the same situation a lot of people were. Does this feel similar to anything else? Do you see what I'm getting at here? Alibaba, the numbers are incredible. The company's growing every day rapidly. It does not need to raise debt. It's not reliant on capital markets. It doesn't matter what its stock price is. It doesn't need to issue more shares to raise capital. It's a highly profitable, fast-growing company that's going down crazy in stock price.
Bust, like the internet bubble bursting, makes it really hard to raise money. But we already had the money we needed, so we just needed to continue to progress.
So he just ignored the stock price. Amazon just needed to keep doing the same things they were doing. So let's just summarize the actual situation here. If you look at the company Alibaba, it is an amazing company, high operating margins, $24 billion in net income in the past 12 months. It has double the revenue as Tesla. It's growing as quickly. It has a massive total addressable market. It has a wide moat rating from Morningstar, and it has investors like Charlie Munger putting $37 million into it. So that's Alibaba, the actual company. But why are investors selling out of it? Why is the stock price tanking? Number one of the Chinese government crackdown are articles like this. Ant Financial, which is a subsidiary of Alibaba, is being forced into discussions to start a new credit scoring business with the Chinese state-owned enterprise. The Chinese government stealing their credit rating data, right? This is a big concern. Investors should be scared of this. What type of government would have the gall to create a competing state-owned business to a credit rating agency? I don't know any type of government which would operate in such a incredibly top-down way, right? Oh, I guess we have the US government doing essentially the exact same thing. The Biden administration has a big target in sights, or rather 3 big targets: Equifax, TransUnion, and Experian. He will create a public credit reporting agency, CRA, to compete with the 3 major credit bureaus to maybe one day replace them altogether. That sounds pretty Chinese government-esque, doesn't it? Why don't you hear it when the US government does it? Why don't you hear the US government's big crackdown on the credit rating agencies? Because it's the US government. And when the US government does something, it's not bad. When the Chinese government does pretty much the same thing, they're doing the exact same thing here. You hear about it on the front page of the Wall Street Journal. That's number one. Number two, when you own a Chinese stock like Alibaba from the US, you really don't own the company. You own essentially nothing, right? You own some shell company in the Cayman Island that has some financial engineering, and it's just funny money. You really don't have any ownership of the company. What type of companies would people ever invest in that have that type of agreement? Aside from the hundreds and hundreds from the United Kingdom, like BP, you have Taiwan, Netherlands, Sweden, South Africa, Mexico, Israel, India, Germany, France, Denmark, basically every European country, South American country, and African country. Even ones across the Asia Pacific are listed as ADR stocks. China happens to as well, but again, when China does it, it's bad. When any other country does it, it's not a concern. And then we have number 3, nationalization. You're hearing talks about China wanting to nationalize certain things. What type of country would ever want to nationalize different aspects of their economy, like education, or oil, or energy production, or transportation, or healthcare, right? No country that's good would ever want to nationalize something, aside from, of course, the UK, United States, and every other European country. Again, every time the US does something, you're not going to hear about it. It doesn't have the halo effect. Every time a European country does one of these things, you're not going to hear about it. It doesn't have the halo effect. Whenever the Chinese government does it, it is the focus, the center focus of attention, because it's the Chinese government. But so far, after everything that I've looked at, I can't find anything that they're doing that's that different than any other country. So unless I'm missing something here, unless somebody can enlighten me to what China is doing that's actually so different than what the US has done, what Europe has done, right now I just see a great company that's selling off because of a lot of fear, uncertainty, and doubt. Anyway, that's my thoughts on the situation. Let me know what you think in the comment section below. As always, a thumbs up and subscribe are appreciated, and I'll see you in the next video.